One of my subscribers asked me to make a video on factors affecting financial markets. Ever wondered why markets rise or fall, sometimes in minutes? What makes investors panic one day and celebrate the next? The answer lies in understanding the core forces that move financial markets. And today, we're going deep. First, a quick disclaimer. This video is for educational purposes only. I am not a financial advisor, and nothing here should be taken as financial advice. What you're about to hear is my personal view, based on research, experience, and market observation. Always do your own research before making any trading or investment decisions. Welcome to Markets and Global Trends. It's a very interesting topic. When I started, I struggled a lot to get the right information in one place. Especially on the internet, there's a lot of misinformation out there. So, here we go. There are multiple factors that affect the financial markets, and understanding them can give you an edge as an investor or trader. Let's start with the big one, economic growth. When an economy is expanding, businesses produce more, consumers spend more, and investments flow freely. This creates a positive cycle with higher corporate profits, rising employment, and optimistic sentiment in markets. But when growth slows, the mood changes. Lower earnings, declining retail sales, and job cuts can trigger fear, leading to falling markets. Key indicators to watch include GDP growth rate, industrial production, retail sales, and employment figures. Next is inflation. It's the slow burn that eats away your purchasing power. While a bit of inflation is normal in a growing economy, too much of it can be harmful. High inflation forces central banks to raise interest rates, cooling the economy but also hurting investments. Inflation reduces the real return on assets and affects corporate profitability. The main measures of inflation are the Consumer Price Index and the Producer Price Index. Interest rates are the heartbeat of the financial system. When they're low, borrowing is cheap. That encourages growth and pushes asset prices higher. But when rates rise, loans become expensive and economic momentum slows down. From bonds to currencies, stocks to savings, interest rates affect everything. They influence bond yields, stock valuations, and even the strength of a country's currency. Behind those interest rate changes is something bigger: monetary policy. This is how central banks guide economies using tools like interest rate decisions, reserve requirements, open market operations, and strategies like quantitative easing or tightening. Monetary policy can either stimulate or restrain economic activity, depending on how it's used. A softer approach can spur growth. A stricter one can help control inflation. Governments also influence markets through fiscal policy. This includes decisions about taxes and government spending. When the government increases spending or cuts taxes, it boosts demand and supports economic growth. On the other hand, when spending is reduced or taxes are raised, it can help slow down an overheating economy. Fiscal policy affects interest rates, public debt, and investor confidence. Geopolitical events are unpredictable and powerful. Wars and conflicts disrupt supply chains and drive commodity prices up. Political instability, like elections or regime changes, creates uncertainty. Trade disputes and tariffs can damage global trade. Diplomatic tensions or new alliances can shift investment flows and market sentiment. These situations often make investors more cautious and lead them towards safer assets. Company earnings are the heartbeat of the stock market. When companies report strong earnings, it shows they are healthy and profitable. This usually drives stock prices higher, but weak or falling earnings may signal trouble, causing stock prices to drop. Earnings reports are closely watched by investors and provide insight into both company performance and the economy at large. Market sentiment reflects how investors feel. Are they optimistic or fearful? When sentiment is positive or bullish, prices tend to rise. When sentiment turns negative or bearish, selling increases and markets fall. Sentiment is influenced by news, economic data, and even social media. Sometimes, market psychology can take over, leading to bubbles or crashes. Supply and demand is the basic rule behind every price movement. When more people want to buy than sell, prices go up. When more want to sell than buy, prices go down. This dynamic applies to everything: stocks, bonds, currencies, and commodities. In bonds, more demand means higher prices and lower yields. In currencies, high demand can strengthen a currency. In commodities, supply issues or rising demand can send prices soaring. Technology is changing financial markets. New innovations like artificial intelligence and blockchain are transforming how we trade and invest. New industries emerge, old ones get disrupted, and markets become more efficient. We now see things like algorithmic trading, robot advisors, and digital currencies shaping the future. Today's markets are globally connected. A financial decision in one part of the world can impact investors everywhere. A crisis in one country may quickly spread to others. Capital flows around the world based on interest rate changes, economic news, and political events. Understanding these global links is key to understanding modern financial markets. Government regulations provide the framework for how markets work. Laws and rules affect trading, investing, and financial operations. Changes in regulations can build confidence or create uncertainty. Too much regulation can slow down activity. Too little can lead to instability. Investor confidence plays a major role in market behavior. When people feel confident in the economy and the markets, they are more likely to invest and take risks. When confidence is low, investors pull back and look for safer options. This shift in behavior can drive markets up or down. Confidence is shaped by data, policy, global events, and overall market sentiment. Currency exchange rates also affect financial markets. A strong currency makes imports cheaper but can hurt exports. A weaker currency helps exporters but may lead to inflation. Exchange rates are influenced by many factors including interest rates, inflation, and political stability. They impact international trade, global earnings, and investment returns. Commodity prices play a big role too. Prices of oil, gold, wheat, and other raw materials affect inflation, production costs, and market behavior. These prices are influenced by demand, supply disruptions, weather, and political events. When commodity prices rise, businesses may struggle with higher costs. When they fall, some sectors benefit, while others may suffer. Financial markets are complex, but when you understand the forces behind the moves, you gain clarity. You gain an edge. So the next time the market rallies or crashes, ask yourself, what factor is driving it? I recommend following reliable news sites like Bloomberg, Reuters, ForexLive, and FXStreet. Bloomberg and Reuters often have paywalls, but ForexLive and FXStreet offer excellent free sections. Focus on the top headlines each day. If you come across a financial term you don't understand, just Google it right away. Stay consistent and give yourself about 3 to 6 months. If you truly have a passion for learning about financial markets, you might find yourself becoming confident even before the 3-month mark. If you found this breakdown helpful, don't forget to like, subscribe, and hit the bell icon. Drop a comment below and share your thoughts. What do you think is the biggest driver of markets today? Stay smart, stay curious, and keep watching markets and global trends.